Well, welcome everyone. Thank you for joining us for today's webinar. Just a quick bit of housekeeping to note before we get rolling. This presentation is for information purposes only. Nothing shared today should be taken as investment advice, nor should it be considered a recommendation to buy or sell any securities. Remember, all investments involve risk, and you alone are responsible for any financial decisions that you make. With that out of the way, let's dive in. Today's session is titled Markets Unpacked, Q2 Insights and Q3 Outlook. We'll take a look at where the markets have been, where they may be heading, and what investors can do to stay grounded, especially with so many headlines that we have flying our way. But first, introductions are in order. I'm your host, Jim Zarosli. I'm the voice of Trader Audio, which is a daily live broadcast and chat room. We analyze the market, stock-related news and notes, trading calls, and some educational segments. And you can hear me starting in the pre-market, and we take you through all the trading day and into the after hours. And I'm honored to be joined today by Patrick O'Hare. He's our chief market analyst at Briefing. And Pat's been with the firm since 1997. He is the brains behind some of the most read briefing columns, such as Page One and The Big Picture. He's not just watching the markets for us. He helps us make sense in a very practical way. So with that said, let's get started. Pat, I give you the floor.
Thanks, Jim, and thanks everyone for joining us today. We really do appreciate you taking the time to do so. In the next 30 minutes or so, what I'd like to cover is a little bit of a summary of the second quarter performance, then share some thoughts on our outlook for the third quarter, and then leave you with some investment ideas out of our so-called bucket list, and then we'll wrap up with a Q&A portion of the webinar. So with that, why don't we go ahead and start? Second quarter, as we all know by now, had a lot of volatility associated with it, but it's ultimately ending on a really happy note. We've seen some tremendous gains across the market for this second quarter. You can see on this chart that the information technology sector has been leading the way. Was up 21% for the quarter as of yesterday's close, and had plenty of sponsorship along the way. It was not alone in driving the market, but as the most heavily weighted sector, of course, it had some outsized influence in driving the market, but saw a nice performance from the communication services, industrials, and consumer discretionary sectors. And really, I think what I point out here on this particular chart, if you look to the right side of it, those four bars that are kind of sneaking below that unchanged mark, the consumer staples, real estate, healthcare, and energy sectors, they represent about 20% of the market capitalization of the S&P 500. So really what we're talking about is that 80% of the S&P 500 market cap had a positive performance in the second quarter, which is what has produced these really strong gains. But again, with that upside leadership from the information technology sector, it's why we're sitting here now on the brink of a new all-time high for the S&P 500. Now, this chart clearly demonstrates that there was volatility in the second quarter. We refer to it as being a thrill ride. I published a big picture column in late February that suggested that the path ahead might be like a roller coaster ride, and sure enough, that's exactly what we saw here. On the left side of this chart, you can see that the year started off on a decent enough note, but started to roll over really as the concern about tariff picked up. You were hearing a lot about deportation efforts, and you're also hearing a lot about the DOGE cost-cutting efforts that were going to possibly be a restriction on economic growth. And then, of course, in the middle of that chart, you see a sharp move in a southerly direction. That followed the Liberation Day tariff announcements, which put a scare in the market, really, as there was a lot of concern that those could ultimately invite a recession for the United States, if not a global recession. But almost just as quickly as that sell-off started, it ended. The president ultimately announced April 9th a pause on those 90-day reciprocal tariffs, and we saw some nice rebound action when he did. Now, interestingly enough, China was excluded from that pause at that particular time, but you can see what's pointed out here on the chart is that The extension of this rebound move really got going when there was talk of de-escalation with China. That ultimately came to fruition with a May 9th announcement from Treasury Secretary Bessent that he and his counterpart in China had negotiated an agreement to roll back those draconian tariff rates we had on each other. And that was another helpful factor here, helping to drive that rebound effort here in the second quarter.
Pat, if I may interject really quick, obviously the tariff pause was a major catalyst for the turnaround that we saw in the market, but were there any other factors that caused that reaction?
Yeah, there was, Jim. There were several factors, really. Those were the primary catalysts, but even what you can see here on this chart, on the left side, you have a chart of what I just call soft data versus hard data. There was a lot of talk and a lot of understanding as the second quarter was unfolding that consumer sentiment was really weakening. You can see that in the dark blue line, which is a measure of the University of Michigan Consumer Sentiment Index, dropped off materially here. Now, the light blue line is a chart of the real personal spending. And while there was some softness that kind of coincided with that initial drop in consumer sentiment to begin the year, you see a hockey stick-like recovery here that happened, which was really a case of front-running those tariff actions. A lot of concern, that consumers are going to be facing much higher prices, and so to get ahead of that, there was a lot of early spending to get ahead of it, and so that's why you saw that hockey stick ramp. But importantly, you see real personal spending continuing on that upward trek. And then also on the right side of that chart, you can see the upward turn to the right in the consumer sentiment index, which coincided, or I should say, came after the tariff pause and the de-escalation effort with China. So clearly a nice pickup in consumer sentiment. So there's an expectation that that will help translate into more solid spending activity here in coming months. And of course, you've had the recovery in the stock market, which doesn't hurt the wealth effect factor, and that's another element that should keep consumer spending on a positive track and the economy on a positive growth trajectory. The right side of this chart covers the inflation reports, the core CPI, core PPI, and core PCE price indexes. These also came in better than feared. Now, it is early days. There is some concern, as we all know and have all heard from Fed Chair Powell, that he, for one, is expecting to see some meaningful pickup in tariff inflation in the coming months. Obviously, that's a disputable point, but the point I'll make here is that it became an expedient for the recovery effort in that the market was able to see that these particular inflation data points did not show any real impact from the early tariff measures. And the timing of these reports was very good. And so you had a market that was on a rebound course, and it was just very comforting to see that thus far there was not a lot of tariff impact from inflation from these tariff measures. So that was those were a couple factors. Another factor was that you also had the first quarter earnings reporting period unfolding around the same time all this was happening. And that reporting period ended up being much better than expected. I would note that at the end of 2024, the FactSet consensus estimate called for 11.1% growth in S&P 500 earnings for the first quarter. When we published our preview of that earnings reporting period, that estimate had dropped to 6.7%. When it was all said and done, the S&P 500 in aggregate delivered earnings growth of 12.9%. So not only did it blow past the downward estimates, it also exceeded the original estimate coming into the year. And that was a very comforting factor for the market, particularly since these mega cap stocks, or many of them anyway, generated some really nice results, had some upbeat guidance, and infused a lot of enthusiasm into the AI trade as a result of it that contributed to some of the momentum factors kicking in here during the recovery effort as well. And then to that end, the performance of the mega cap stocks was extraordinary coming off that April 7th low. We look at the Vanguard Mega Cap Growth ETF, the symbol is MGK. kind of as a proxy for that mega cap cohort. And it was up 37% from the April 7th low, which is just remarkable. And it compares to a very nice 26% gain for the S&P 500. But you could see the outsized impact of those stocks, and that ultimately helped contribute to the nice recovery effort that we've seen.
So, Pat, we've had a pretty good look at the equities, but I think we need to talk a little bit about the treasury yields and some of the reaction in the bond market.
Sure, yeah, and what we have here is a chart of the 2-year note yield and the 10-year note yield. I should have included this before. I'm glad you did bring this up. I guess we would have covered this eventually, but in terms of catalyst for the recovery effort, Jim, this was certainly among them. You had a treasury market that, all things considered, has been pretty well behaved, we would argue. You can kind of see in early April that we had a nice jump up in the 10-year note yield from 4 to 4.5% in pretty quick fashion. And that was, driven in part by the tariff concerns that they would lead to higher inflation. Also had some deficit angst being talked about around then too. But what this chart also demonstrates is that there hasn't really been a breakout of these yields. We've kind of tracked sideways here, so they've been held in check despite all of the deficit talk and the inflation talk. And something that's remarkable right now is that you have the 10-year note yield and the 2-year note yield both trading at lower levels than when the year began. And so the fact that treasury yields have remained well behaved, all things considered, definitely a support factor for the stock market's recovery effort. And on top of that, I would add that what we also saw happen here was you had a lot of short covering activity with the recovery in the S&P 500 that led into some momentum investing, and then really you also had the fundamental catalyst of that. Market participants came back around to thinking that with the rollback and the reciprocal tariffs and the China de-escalation, that it took the recession factor off the table, as did the arrival of some hard economic data that kind of quieted those recession concerns. So the market got back to thinking better things about the earnings outlook, and that was all factoring into this really strong performance in the second quarter.
Well, we certainly saw a whirlwind in that second quarter, full of surprises, volatility. But before we look ahead, I do want to touch upon something with you. Do you think that the market's recovery off the April lows was more of a fundamental driver, or was it more driven by momentum and fear of missing out?
Yeah, I think it's all of the above, Jim. As I mentioned, the fundamental catalyst kicked in when the hard data helped quiet those recession concerns that many had, viewing that soft survey data that wasn't looking all that great. It also kicked in when we saw the reciprocal tariff rates get pulled back to more palatable levels anyway. And so that was a nice fundamental catalyst here for the market. And then things just kind of started feeding on themselves. The price action itself became a really notable catalyst, because you had a market that had been inclined to sell into strength pivot into one that was really buying on any dip, and not even a big dip, any dip. And we saw that again, contribute to short covering activity, and certainly a fear of missing out on further gains that drew cash in from the sidelines and affected what we called a flat squeeze, really, by participants who might have been sitting on those sidelines in cash, fearful about being invested in the market, but seeing the market doing what it was doing, chose to put some of that cash back to work, and that helped things along as well.
All right. Well,
So
that was a. Oh, I'm sorry. Go ahead.
Well, I was going to say, so, with that, kind of wrapping up that second quarter view, as we transition here, kind of looking at the third quarter and some of the factors that are going to be fairly important here for the market. I've identified 3 on this slide, and I have to, laugh somewhat at the first one, because I started this presentation before we had dropped any bombs on Iran's nuclear facilities. And there was some suggestion that it might be a few weeks before we even made any decision to do that. But that all changed on June 21st when the U.S. led a bombing strike on Iran's nuclear facilities, and obviously created some nervous energy in the market. But what we've seen since is a de-escalation of that particular conflict that has helped a great deal, and you see that manifested in the sharp pullback in oil prices as the market has concluded that we're likely not going to see a widening in that conflict in the area, and you're not likely to see a major disruption in oil supplies coming out of the Middle East. And so what was a negative factor, or what I was thinking could be a negative factor when I started this presentation, has pivoted to a positive catalyst here in more recent days. And it's also nice to see that you've seen those oil prices come back down. So again, it kind of mitigates some of the concerns about how higher energy prices could have possibly acted as a further restraint on consumer spending activity. You also have this one big beautiful bill that everyone's talking about and seemingly debating still. The president has set a July 4th deadline. He'd like to have it on his desk to pass by then. The Senate's still working through its version. It's going to have to come back to the House and get reconciled there. And so the timing of things is a little bit up in the air, but clearly still some points of contention surrounding that SALT deduction cap and the reductions in Medicaid and SNAP benefits. And so a lot of loose ends right now as it relates to that particular bill and the timing of when it's going to pass. It's not the end of the world if it doesn't pass by July 4th. But we do have a debt ceiling issue that's going to need to be tackled, and Congress is going to have to address that most likely before August. And just the big broader point, just keep in mind that the provisions of the 2017 Tax Cut and Jobs Act, they expire at the end of 2025. So I know that the GOP-led Congress and the president certainly doesn't want this negotiation to continue throughout this year, and they want to get this wrapped up pretty soon, but still a loose end at this point, but something that could possibly be tied up here as early as next week if the Senate and the House GOP get on the same page and get this bill passed. And then we have the reciprocal tariff pause. While it was clearly a catalyst for the recovery in the second quarter, keep in mind that the expiration date's coming up on July 9th. Now, the administration has said that it could be willing to extend that pause for countries negotiating in good faith with the United States. But we really don't know what's going to happen. It's going to be a game time decision, and it's going to matter greatly for the market, what countries have that pause extended and which don't. But so that's another potential disruption factor here as we get rolling to start the third quarter. Couple of things that are not on this slide that we do need to keep into consideration that are going to be impactful in the third quarter is the arrival of the second quarter earnings reporting period. Kind of like the first quarter reporting period, we've seen estimates get marked down. That's not atypical. That often happens before an earnings reporting period as analysts get more information toward the end of a quarter. And then you often see these companies come in and hurdle those lower expectations. And so we've seen the estimate get marked down to about 4.9% earnings growth for the S&P 500 in the second quarter. That's down from about 9.3% at the end of March. So the key thing here, though, as we navigate this third quarter is what these companies are going to say about the third quarter and the back half of the year. Because you had some fairly reassuring guidance in aggregate coming out of that first quarter reporting period, you saw a nice, that was a factor contributing to the rebound effort. But at this juncture with valuations where they are, the market's going to want to hear continued optimism about the earnings growth outlook from companies across all sectors, really, but particularly from that out of that information technology sector and those mega cap stocks. And then finally, we have the Fed. Right, the Fed's going to be in play, has two meetings here in the third quarter, one in July and one in September, and it's it's a guessing game at this point in terms of what the Fed might do. We've seen some dual speak, if you will, from Fed officials recently. Fed Governor Waller, Fed Governor Bowman, kind of floated the idea that they're open to a rate cut in July. Fed Chair Powell, I wouldn't say he closed the door on that idea in his semi-annual monetary policy report. Seemed a little bit open-minded to it, but he was kind of still reiterating the fact that he's wanting to wait and see more data before figuring out what the next step is for the Fed and when they might ultimately cut interest rates. So given all that, let's take a look at valuations here. With this strong recovery that we've seen in the market, we've also seen a pickup in valuations. The chart on the left is the PE for the S&P 500. And right now you have the market trading at about 22 times forward 12-month earnings. And that's close to a 20% premium to the 10-year average. On a trailing 12-month basis, it's trading at about 24 times earnings, which is about a 16% premium to that 10-year average. So we can objectively say that you have a market here that's trading with a full valuation, certainly, and arguably quite a rich valuation. The chart on the right is the PE ratio for the S&P 500 equal weighted index, and here the valuations are much less demanding. You have a forward 12-month earnings multiple of about 16.8 right now. So it's sitting just about on top of that 10-year average of 16.5. And the same thing goes, on a trailing 12-month basis, trading around 18.3 times earnings, which is exactly in line with that 10-year average. And so again, it's a full valuation, but not as demanding of a valuation as we see in the market cap weighted S&P 500, which is, of course, unduly influenced by the performance and of those mega cap stocks. This next slide, I don't mean to put it out there to scare people, but I thought it is interesting to put out a reminder again of just the fact that we're sitting at a high valuation right now. So investors looking to allocate money into the market should recognize that they're starting from a point of high valuation that could ultimately diminish total return potential. And what the Buffett indicator is that this was a valuation gauge espoused by Warren Buffett. He looks at the Wilshire 5000 market cap as a percentage of nominal GDP. And you can see we're sitting just below 200% here in terms of that percentage, which is, as the chart shows, very high. It's higher than we were at the peak of the dot-com crisis. It's higher than we were at the beginning of the financial crisis. And it's about where we were in March 2022 when the Fed was just starting to raise rates to get inflation under control. And you can see that the market certainly had its challenges in 2022. So I just put this slide out there just to, again, remind people that, we're starting at a point of high valuation. And so it's important to keep that in mind as far as managing risk within one's portfolio and not to get complacent here, even though we've seen a really strong market performance here and a nice comeback from those April 7th lows. So with these high valuations come high expectations for earnings, right? We need that to come through to support these high valuations. So where do those estimates stand today? The dark blue line here is the forward 12-month earnings estimate. The light blue line is the calendar year 2025 estimates. And you can see they've diverged since the start of the year. But the forward 12-month estimates showing a nice upward move, having inflected really right around the time those tariff pause announcements were made, trading at right about $280 per share in terms of the estimate right now. And then the yellow line you see on this chart is the estimate for calendar year 2026. It's also come down since the start of the year, but we've started to flatten out here, sitting at 298.69, which if everything held constant at these levels, that represents year-over-year growth from calendar 2025 of about 14%, which is a very nice return if we can get it. Now, I would contend that the market is leaning more or looking further ahead into 2026, really, probably leaning more on that estimate than it is on the calendar 2025 estimate because, well, frankly, it's priced for a lot of positive outcomes as it relates to the big, beautiful bill, to the trade deals, to interest rates, to earnings growth. And that's sort of a justification in its mind to stay elevated here at these high valuation levels. And so as we navigate our way through the third quarter, it's going to be really, really important that companies deliver the earnings growth that's expected and hurdle the bar of earnings estimates, not just meet it, because if we want to see any expansion in that P multiple, we're going to have better earnings from here. So given all that, what should investors do at this juncture, right? Our position is that the market cap weighted S&P 500 seems to be trading with a pretty rich valuation. So one thing that we're suggesting that passive index investors may want to do is to allocate new money into the equal weighted S&P 500, simply because it's a less demanding valuation and we think has a better risk reward trade-off at this point. I say that with a little bit of a tactical approach in mind, because these mega cap stocks have been so awesome in terms of their performance here on the recovery effort. A lot of them are overbought, on a short-term basis, likely going to be due for some consolidation. And then, of course, if they don't come through with the earnings growth that's expected, and you have to believe that there are high expectations for these companies going in, there will be a correction in those names, and that will disproportionately weigh on that market cap weighted S&P 500. Not that it won't weigh on the equal weighted S&P 500, but if you get into a situation like that, we just think that that the risk reward element is more attractive here for investors in that equal weighted S&P 500. Now, for active investors, we would suggest considering some investment ideas from our so-called bucket list. So let me go through those real quick for you, and then we'll conclude with a Q&A portion here. The first bucket we term, really just attractive PEG ratio, right? The PEG ratio is a price to earnings growth ratio. And some companies that our analysts here at briefing.com like are Dana Inc., Signet Jewelers, and Uber in this regard. Dana Inc. is an automotive supplier. It's in a turnaround mode right now, but clearly still solidly profitable, as you can see between the delta between the fiscal 25 estimate and the fiscal 26 estimate. Currently trades with a forward PE of 9 and a PEG ratio of 0.3. So pretty underpriced relative to the company's growth potential. Signet Jewelers is the largest retailer of diamond jewelry. This is a company that's going to cater more to more price-sensitive consumers looking for jewelry through their Kay, Zales, and Jared brands. This is a company coming off of a beat and raise report in the first quarter. It's closing underperforming stores, and so that could ultimately lead to some improved profit margin potential. Also solidly profitable, trades forward PE of just under 8 and a PEG ratio of 0.7. And then lastly, Uber. Many of us know the name. Many of us have used the services. It's a rideshare and delivery company with approximately 70% U.S. market share. Over 170 million active users in the first quarter, and on the heels of its first quarter report, put out a pretty upbeat gross bookings outlook for the second quarter of 16 to 20% growth. And one thing that is helpful with Uber, as we look at it on a longer term perspective, is its ambition to integrate robotaxis into its platform. That can ultimately help drive out a lot of costs related to driver costs and expand those profit margin potentials. Now, Uber is very well managed, and while its forward PE of 25.9 doesn't look like a true bargain here, the PEG ratio of 1.19 is significantly underpriced relative to the market PEG of about 2. So we still think it has some attractive potential there and good growth prospects. The second bucket is companies that we think would be less exposed to tariff issues. Now, the first one on this list, Whirlpool, you might say, how could that be? I mean, they use steel in terms of their manufacturing process. They're going to get hit by those steel tariffs, and that is true. But the company has described these tariff issues as a short-term manageable headwind. Whirlpool is the largest kitchen and laundry appliance maker, and it is going to be in a bit of between a rock and a hard place here for through this quarter, maybe the next quarter, because you had Asian suppliers kind of flood the market, so to speak, with appliances in front of those tariffs. And so the industry has to work through that inventory. But But the benefit for Whirlpool is that when you work through that inventory, the tariff issue becomes less of a headwind. It produces 80% of its domestic sales in the U.S., and that's going to be a nice advantage for that company when these Asian suppliers ultimately probably have to raise prices once they've worked through that inventory. And so we also think Whirlpool stands to benefit from any pickup in the housing market that could be brought on by lower mortgage rates. So if we get the Fed cutting rates, in the latter half of the year here, and we get some stimulus in that housing market, Whirlpool's in a great position to benefit from that. Not a demanding multiple at 8.5 times forward earnings, and it also offers a pretty handsome dividend yield of 7.3%. So investors kind of get paid to wait for these headwinds to dissipate. Visa is the largest payment and processor network. It's digital and asset light, so a lot less exposure to the tariff headwinds. Just announced a new $30 billion share repurchase program and has offered a pretty nice fiscal year 2025 outlook. So another name that our analysts like here. And then finally in this bucket, Costco, leading membership warehouse retailer. One thing that jumps out at our analysts is that the company, about a third of its U.S. sales are imported, and only less than half of that come from China, whereas Walmart, for instance, imports about 60% of its products from China. And so we think that Costco, with its commitment to maintaining, to holding the line on price increases, will really underpin its value appeal to its consumers, has an over 90% membership renewal rate. There's no doubt that this company is really well managed and has that defensive orientation in the event we do get into a slower economic period. Stock is not inexpensive, but that's because it is so well managed and it's delivered some really strong results. The third bucket, steady growers regardless of economic conditions, have a couple names to highlight here. Entergy is one of them. Our analysts like this electric utility company in large part because of where it's based. It's headquartered in New Orleans, but covers an expansive area through the southern United States, and migration patterns are very much in favor of the southern U.S. And this is a company that's also adding data centers to its customer portfolio. So a nice growth opportunity in that respect for Entergy, which also offers a pretty decent dividend yield of 3%. Intuitive Surgical is the largest robotic-assisted surgery company with over 60% market share. Has a really good business model that's capable of delivering recurring revenue, which then in turn can deliver some predictable cash flows. So that's a nice benefit there. It's a steady grower. It has plenty of applications in non-discretionary surgery uses. And one of the benefits of its Da Vinci systems really is that they improve the clinical outcomes in terms of surgical outcomes, which in turn help reduce the time in hospital and helps cut down on hospital costs. And that enhances the appeal of adopting these Da Vinci systems. The company also recently provided some upbeat guidance with respect to its fiscal year 25 procedure growth outlook. The fourth bucket, what we simply term companies with quality attributes, right? There can be any number of companies that do kind of fill that bucket. But we think one way to kind of approach this is through the ETF, this JP Morgan US Quality Factor ETF. You get exposure to a lot of quality companies measured by profitability, quality of earnings, and solvency here. We like this particular ETF for the quality factor because it's more diversified than some other related ETFs. Over 273 holdings, and only 19% of the fund's assets are in the top 10 holdings here. It also has the lowest expense ratio among these major quality ETFs. And frankly, if we do get into a more challenging economic period, quality companies are going to do better in those tough economic times. And then the final point on this is that while we're advocating more of an approach to the equal weighted S&P 500 at the index level, if someone doesn't want to give up, as much exposure to these mega cap stocks, this is another way to kind of add some leverage to that particular play. NVIDIA, Apple, Microsoft, Meta, Alphabet, they're among the top 10 holdings in this particular ETF. And then finally, our fifth bucket are secular growth trends. two that we have here clearly don't cover all of the secular growth trends that are available. There's certainly ideas that one could pursue in the cryptocurrency space, quantum computing, space, even healthcare for that matter. But two that we're pointing out today that our analysts like are the iShares Cybersecurity and Tech ETF. That symbol is IHAC, which I personally like that symbol. This is a company or an ETF that also spreads risk out across a larger number of holdings than other ETFs in this space, has the lowest expense ratio among those related ETFs, and doesn't overweight anything in particular with any given stock. It is populated with some smaller size companies, so that's an interesting element as this growing space and this secular trend is likely to invite takeover potential, and that could include the names in this particular ETF. The final one is the Global X Artificial Intelligence and Technology ETF, another well-diversified ETF with 86 holdings. This particular ETF revolves more around actually the growth in the robotics industry. We just heard yesterday from CEO, NVIDIA CEO Jensen Huang, that robotics is the next best growth industry for NVIDIA behind AI. And so a lot of potential here on a secular trend basis for robotics. And the AIQ has greater concentration of blue chip companies, which can be a benefit here, given that they have ample financial resources that give them that competitive edge in an early growth stage proposition. So with that, Jim, wrapped up those buckets. So I'm going to throw it back to you for the Q&A section.
Yeah, I really like the framework of the investment buckets that you talked about, Pat. I think it works well for active and passive investors. I do want to open it up to questions, though. We've got a few from the live chat. Unfortunately, we won't be able to get to them all, but we will try to get in a handful of them. And Pat, I want to start off with one that might be pressing very soon. Do you think the Fed will cut rates at its July FOMC meeting?
Right. Well, thanks for the question. The latest look at the Fed Funds futures market showed about a 23% probability of that happening. Now, that is up from 12.5% a week ago. So we've seen a near doubling in that expectation. But that low probability implies that the market is still not on board with the idea that the Fed is going to cut rates at the July meeting. But of course, you asked, what I think the Fed is going to do, and I do think that the Fed is going to stand pat with that, with the target range for the Fed funds rate, 4.25% to 4.5% at the July meeting. Now, the caveat in this is that we haven't seen the inflation reports for the month of June that will come out in the middle of July. That's the CPI and the PPI data. If those continue to look pretty soft, then I would change my thinking in this regard, and I think the Fed would ultimately cut rates in July. You're starting to hear a lot more. I don't know if pressure is the right word, but certainly the narrative seems to be changing in that as I mentioned earlier in the presentation, you heard from Fed Governor Waller, Fed Governor Bowman, talking about their open-mindedness to cutting rates in July if inflation pressures remain contained. Fed Governor Waller, frankly, doesn't think you're going to see any real tariff-based inflation pressures, and so that's driving his particular position. Of course, the Fed chair is the one who needs to be convinced here, but at the moment, I don't think they will cut rates. But it is interesting to note that the median forecast in that summary of economic projections, it does call for 2 rate cuts before the end of the year. And so, the end of the year is going to come at us pretty soon. You have a meeting in July, meeting in September, another one in October, and another one in December. So with an expectation that you're likely to be 2 rate cuts before the end of the year, that would imply an outlook on the part of the Fed that suggests either inflation is going to be at a comfortable enough level that it can cut rates, or that you're going to get weaker growth that is going to demand an interest rate cut. And if you have that weaker growth anyway, you're likely to see inflation come down as well. So we're not far off, we think, from the prospect of a rate cut from the Fed, maybe not in July, but certainly in September.
Okay, I want to respect and honor everyone's time here. So I'm going to toss you one more question. And this comes from Bryant. It says, I keep reading and hearing a lot about how the reconciliation bill is going to drive up the deficit, which can cause interest rates to spike. Would it be better or worse right now if the reconciliation bill did not get passed by Congress?
Well, thanks for the question, Brian. And that is a real hot topic of debate, right? And I guess I would couch my answer by saying I'm going to fall back on the treasury market to kind of clue us in here as to what would be the worst outcome. As I said earlier in the presentation, treasury yields have been pretty well behaved, all things considered, even though we've had this big, beautiful bill out there lurking with CBO estimating that it's going to add $2.4 trillion to the primary deficit over the next decade, and it'd be 2.8 trillion when you factor in interest costs that come into play. But the treasury market, you haven't seen any violent response, I guess is how I could term it, from the so-called bond vigilantes. It's not to say that we can't get one. It's just to say that we haven't really seen that yet. You have the 10-year yield trading roughly in the middle of kind of where it has been from on a long-term average between 4 and 5%. So not a lot of abject fear in that trading right now as it relates to what the market knows about the deficit conversation. So we'll have to see how that does play out. So in answer to the question, I would contend that the bigger risk for the market would be if the bill did not get passed, right? Because if the bill does not get passed, you're going to see a massive tax increase for everybody. And that's going to change the whole outlook in terms of how the entire earnings outlook. It'll change the economic outlook, which in turn feeds into the earnings outlook. And with a market sporting these high valuations that we've been talking about, you can't get that earnings situation degrading here. So in my mind, the bigger risk would be the bill not passing.
Okay, well, that's all the time we have for today. I want to thank you all for joining us. Before you head out, please take a moment to complete our quick 3-question survey. It really does help us improve these sessions and gives you a chance to share the recording and get more information on briefing.com subscriptions. So on behalf of myself and everyone at the briefing team, I want to thank Pat O'Hare for unpacking all of this with us. And thanks to each and every one of you for being here.